O'Shea,
Stephen Jester representing the police department.
Mark Izzo,
Kevin Costa, representing Police Department.
Bob Schalligan, representing the Fire Department.
and I'm Jim Jascott, the Finance Director.
And I'm David Borowy, a town council member and liaison.
Okay, and then we have our Morgan Stanley folks.
Ross Charkatz with Greystone Consulting, which is part of Morgan Stanley. And
Amanda Tomey, also Greystone Consulting.
Excellent. Okay, I don't see a flag, so we're going to imagine we have a virtual flag somewhere, and I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Kind of a little bit of a round. Okay, here we go. Has everybody had a chance to look at the 5 minutes from the May 24th meeting? Any comment, any updates? Okay, I'm gonna make a motion to have those minutes approved. Can I have a second?
Second.
Okay, that's easy. There is no old business, and Ross, we're gonna go right to you. You and Amanda.
All right. So we don't have any decisions or recommendations for this meeting. So really, just to get everybody kind of up to date, and then really want to just make sure respond to any questions, comments, etc. Obviously, a lot going on here. And so, Jim, I think you may need to enable me because it says it's host disabled the participant screen sharing.
Bear with me now, I'm trying to,
My hunch is that maybe usually on mine at the bottom it says share screen sort of in the middle. There might be like a little caret next to that or something where I don't know if it's yours is
Got
the
it.
same as.
Jim just gonna start his screen sharing. We are technological geniuses.
Well, that's okay. So that's your screen share. I think you need to enable.
yep, bear with me.
No problem.
Whoa.
That is quite a screen.
That Jim has on his phone, where you have, missed phone calls, or missed emails, 700 and.
That'd be me.
Yeah.
My personal stuff.
Ross, bear with me a minute.
No worries. Take your time.
Ross, did that do it?
Says he's the host now.
Yes. Yep. Give me 1 sec.
Beautiful.
Right. We can all see now. All right. As of the end of July, ages ago, what you'll see here is that the the main plan or the large plan had a little, about 84, almost 84.5 million in it. And we're just showing a year-to-date column. I'll comment in a minute, because July was a bit of a balance in markets and in the portfolio, but nevertheless, through the end of July, the overall portfolio was down just shy of about 9%. Over the last year, down about 6.4%. And which will, I guess, we just continue to carry this here. Eventually, this will go away. But I know we commented a bit last time and had before that that since the notwithstanding the pretty sharp declines, so far this year, that since the COVID crisis, on a cumulative basis, equity markets, actually not bond markets, but equity markets are up, in the portfolio's cumulative return is actually up a little over 33% over that time period, even including this year's declines. And of course, you can see the last 3, 5, 10, et cetera years in terms of actually more normal compound average returns, going out 6% and change over the long haul. And the Police Healthcare Trust, Firefighters OPEB, which are sort of a little bit different, don't have the alternative investments. Allocations are a little bit different underneath the hood, but nevertheless, you can see those numbers so far this year, pretty much in line, a little bit more on the downside, given the fact, I think, that they don't have quite the alternative allocation that has helped the larger pools of money. But you can see, how that plays out a little bit over the longer haul in each case, to the right of that line. And just as a little bit of a frame of reference, I mean, if we look at, let's just say, so far this year, the portfolio being down about 9%. Global stocks, and this is pretty much across the board, whether you're looking at the U.S. or outside the U.S., but this just combines, are down about 14.5%. Bonds, which, as we know, have not been protective this year. Again, recounting things that we talked quite a bit about in the last meeting, and throughout this year, down about 8%. And so just a 60-40 blend, kind of as a broad benchmark for kind of a standard underlying asset allocation, down about 12%. And you can see over the last year, down almost 10% for, again, a sort of a standard asset allocation. And going back to that earlier column, just the comment about the cumulative returns really since this is sort of like not all the way at the lows, but because that happened in like the third week of March, but just off that, you can see that stocks are up about 50%, bonds and are down almost 6%, and that's including the income that bonds deliver. So it's the price plus the income on a cumulative basis are actually down over that time frame, and a 60-40 blend being up about 25.5%. So I think, at least in the shorter term, on that basis, and of course that comes from a variety of places that I'll mention, but on a shorter term basis, over the past 2 and change years, portfolio has held up, has done well both on the upside and actually here, notwithstanding that it's down, but held up a bit on a relative basis on the downside. And that's a little bit, actually, you'd like to have one or the other. To have, sometimes you'll have a little bit of both. And so far, we've had a little bit of both through what is, clearly a tumultuous period. I really don't, certainly we don't think that these are multiple periods where the market went down and that was one, and then the market went up and it was another. Now the market's this is really all one, really one big period of time, and it very well may be sort of the beginning of a longer term secular type of a market environment, and not just sort of a short term blip in terms of what the underlying macro factors are that are driving asset prices and driving really global economies. Just in terms of just overall, kind of catching up on portfolios, as I mentioned, no portfolio recommendations. We did make a commitment not long ago to General Atlantic, which has made a very, very small, in June. These are just sort of activities in between from the last meeting till now, made a very small capital call. So there's very little invested in that fund, although I'd imagine maybe the time, may have been timely to have made that commitment, given that the areas where they invest have a lot of growth potential, but are probably the most beat up recently. So it'll be very interesting to pay attention to what they're doing. And then, as occurs every year, in July, town made contributions to pension firefighters plans, approximately 4.8 million in total, and those are in the portfolio. And of course, we use that for a variety of things, including the plan for payments that go out as well. So it's really more of a liquidity function. And just really a couple sort of adding on just from on the market side, as I mentioned before, I mean, it's been an extreme environment. It's been certainly no exception this year. The rebound in both stocks and bonds in July, has kind of taken some of the edge off the year-to-date decline. So, good job moving the meeting out a month. So the numbers don't look, nearly as extreme. Because July was particularly, difficult, rough market environment. Just to give kind of a sense, as of the end of June, the numbers that we would have maybe otherwise looked at if we were meeting a little bit earlier, the ACWI, global stocks were down about 20%, bonds were down about 10%, and in just the month of July, stocks were up almost 7%, bonds were up about 2.4%. So that contributes to just even a pretty substantial difference just from one month to the next. We don't really read too much into it in terms of this recent rally. Really, probably not much more than just normal market dynamics. You do tend to get the most powerful market rallies in bear markets, not in bull markets. Bull markets tend to be a little sleepier for the most part. And you can kind of see, like, I just use the MSCI US growth, right? More of the technology-oriented type stocks, things that were the real leaders, particularly in the COVID period, is the area that's been most beat up. It was down. It was up over, 13 and change percent. So more than or almost double, I guess, just what global stocks did. But even with that, still down about 20.5%. So it was down about 30%. As of June. So, growth stocks have really taken it on the chin. One thing that we'll maybe spend a few minutes on, because I think it's relevant just on a longer term basis, is that the outlook in terms of just risk reward for U.S. oriented portfolios will probably be more challenged. We think going forward. Probably when you just combine stocks and bonds, it probably looks a little bit more like what we've seen if you were to just sort of sum up the last 20 years worth of returns, maybe not the last 10 or the 10 ending at some point recently when U.S. has outperformed international, but maybe if you sort of add up the period before that and this one, and that for just from a risk management standpoint, and this is something I know we mentioned before and we continue to emphasize. But that a more active risk management component in a portfolio, we think, takes on greater importance in an environment such as what we seem to be experiencing. And when I say more than just asset class diversification, and because I think that the concept of having bonds in particular protect the portfolio, bonds were really an unusually effective hedge for a very long period of time because, bonds, treasuries, high quality bonds, when the stock market, has gone down, they have, risen in price, right? So it's been a hedge and you've been paid some amount of income. And, usually if you think about, a hedge, like insurance on your home or some other type of a hedge, usually that costs you money. And as long as your home doesn't have a fire or some catastrophe, economically you'd say, well, I lost that money, but at least you felt protected, at least from that standpoint. Here, bonds have been a hedge that have actually paid you to own them. And so I think going forward, the way that we're going to need to, I think we've thought about this, but I think we'll continue to need to think about it, maybe think differently than we have in the past, is that there is income and there is, diversification in terms of, diversifying your downside risk. And we think they're more and more separate things, not one thing in and of themselves. And so we may need to, and I think we'll continue to need to look for, risk management from assets and types of strategies that we think will manage risk, and income from strategies that we think will provide income, but they may not be quite the same thing at the same time. So I take a breath there for a minute, and we can kind of jump into a few other things, but just see if there's any questions or comments you'd like us to respond to.
Very good.
Okay. I think maybe a couple things that we can, kind of go through. I mean, one is, and I'll put this on the screen in a moment, but kind of use the a lot of this information is on the page before, a little bit more on here than the others, but we'll kind of follow along. So this is the larger the portfolios, and sort of the standard dashboard that we look at, and breaks things down a little bit. You can kind of see where assets are, where returns are.
Page 14.
Page 14 of 48 if you're not looking on the screen. And what you'll see here in so far in this year is that just in terms of just traditional stocks, bonds, strategies relative to the alternative investment strategies. And by alternatives, I'm excluding the illiquids, right? So these are just really the hedge funds. You can see that clearly the hedge funds, the alternative investments, so far this year, and of course this bleeds out a little bit into the 1 year column, is really the area that is helping the portfolio on the downside. I mean, effectively flat, slightly below flat over the last year, while traditional assets are negative. And that is I would say intentional. I want to say somewhat by design. But if you recall that really the main objective of quite a few of the alternative investments we have here is to actually be a diversifier when we need it. And by and large, so far, that has actually worked out pretty well. I think I may have, if I didn't make the comment before, I think that I'll make it again. But even if I did, it still holds true that for the most part, so far, I would say this year that if you knew what all of your investments were, what their strategy is, what their underlying asset allocation is, U.S. stocks, international, various types of alternative strategies, and you only knew a few things. You knew that stocks were down, you knew that interest rates were up, you knew just sort of the high level factors. What you would basically have expected under those circumstances is pretty much how things have played out. And as much as that does not sound like a profound statement, as many of you who have been around the block before in markets know that when things start to get volatile, especially when the world around us is getting weird, investment performance starts to get weird in the short term. And I suspect that somewhere in here that'll happen. The things that we expect to happen that we think are going to be less risky will turn out to be, will look more risky for some period of time, and vice versa. The things that we expect to be risky may appear to be less risky, and we won't really quite know why. But so far we haven't really, I mean, it's not a prediction. It's just historically you've just had weird things happen. It hasn't been, it actually hasn't been that weird. We know this year, and some of these are shorter term numbers because we've recently added, for example, Hamlin to the portfolio. But as you'll see, the value managers, the more value oriented managers in terms of what their underlying holdings are, have gone from a period where growth was outperforming to where value is outperforming. And so Hamlin has actually done reasonably well, actually positive over the last year. ClearBridge, being a more growth oriented manager, is down about 18% over the last year. I would not let the Russell 1000 Growth Index fool you into thinking that they're actually doing particularly poorly. On a relative basis, it's interesting. You can see if you may be looking at other investment managers, you can see most managers are down, similar to where ClearBridge is. ClearBridge is a little bit better. But if you look at the Russell 1000 Growth Index, I don't have the exact figures in front of me, but I think that Microsoft and Apple are like close to 20% of that index itself. And so just the fact that those are so heavily weighted and have held up, I think maybe Amazon and Tesla or something in the next two. So unless your investment managers own two or three stocks that make up 30% of the account, and they happen to be two or three that have held up in a very short period of time, sometimes you get a little bit of a weird number. But I don't think there's anything to read into that. And really just on down the line, Tweedy, who's a newer manager in the portfolio, they're going to suffer if the market goes down, but they've gone down considerably less than markets over certainly the past year since they've now been in this portfolio. And so that's nice to see. Oppenheimer, more of a growth manager. So really down the line, again, as I mentioned, not anything that looks sort of off the wall to us. Fixed income has been, again, a bit of a challenge. Nothing looks off the wall to us just in terms of relative to markets. And JP Morgan, again, just being slightly flat, you might think, oh, how smart are they? Smart, but bear in mind that portfolio, that particular portfolio is run intentionally to have no duration exposure. So we're as close to zero as you can get. So as interest rates have moved up, it hasn't had, the prices of those bonds haven't responded to the downside. So that portfolio is held up. It's run in that fashion. And then really to round it out, when you get into the alternatives, one by one, you're going to get a little bit of a mixed bag, particularly like with something like Pointer, which really is an equity alternative. So it's going to have a pretty high beta or even a high correlation to what equity markets do. Maybe it won't go down quite as much. They've probably suffered a little bit more for reasons that that at least we can talk about. But then they have historically in down markets, but nevertheless they're gonna have some directionality to them. And then when you kind of go through the other managers, Ironwood, TPG is an equity manager, but so that one probably really does stand out because you would expect them to be down somewhat with markets, and they're actually up. Although they look like paint drying when everyone else was going up. And then really when you kind of get down into the more macro managers, the ones that, will once in a while, you or other clients will maybe ask us about, why are they here? They don't look like they're really doing anything. They're kind of a drag on the portfolio. But really for them, it's not necessarily what their performance is, along with markets. It's actually when they perform, and they've, again, with they both of them have performed not only well, but when you would want them to perform. And this is really an area where we look to for sort of true diversification, things that are not going to have any correlation, with what general markets are doing, and it's intentional in terms of the way those strategies are run. So that's why, just to kind of round out in terms of, to sort of substantiate the comment that, in this period of time, it just hasn't been, it's been down, it's been difficult, it's been a lot of head scratching. But in terms of looking through to what the underlying strategies are and saying, is anything out here, sort of stand out to you as unusual? The answer thus far, really pretty much across the board, has been a resounding no. So are there any other questions? Or, I know, Michael, one of the things that has come up before was the international versus U.S. Or any other big questions. Or not. Hopefully that kind of gives you a sense of things. But I guess my formal remarks will maybe end there, and then I'll go to the informal ones. If you have any.
So to touch on that, because it looks like our equities right now are pretty much actually a little tilted in total to international, maybe about 55-45. So just comment on that a little bit. I know, we're always looking backwards, and portfolios are supposed to look forward. I know valuations and other things, and dollars, the value of the dollar and all that stuff. So why don't we just briefly touch on that?
Yeah, look, this is I mean, U.S. versus non-U.S. I think so. To your point, I think if you look back at the in U.S. stocks versus international stocks, clearly U.S. for a very long time here has done much better. I mean, you would be much better off buying, let's say, the S&P 500 than you would be buying like the MSCI, EFA index, Europe, developed markets. And there's a variety of reasons for that. I think that the world. I mean, these are to just look at the obviously under the index is really what drives that. It may not necessarily be because it's U.S. versus non-U.S. Sorry, let me 1 second. I just want to. I pulled up a couple. It may not just be because U.S. and non-U.S., but there's clearly a component, particularly given if you think about the world, a lot of money, a great deal of money, is invested with really no. I'll go so far as to say with almost complete disregard for underlying fundamentals. And how can I make that? It may seem like a pretty edgy statement, but so much money really is benchmarked, and by benchmark it means it could be either invested in index funds or the funds themselves are being managed so that they don't veer too far away from benchmarks. So in effect, a lot of money really it just invests with wherever the market is, and so things do tend to move, in baskets. So you get an effect over time as the whether something's in the U.S. or outside the U.S. of things moving together. I guess a couple things, Michael, I would say is that so to sort of substantiate the comment that U.S. has outperformed, it certainly has, and it's been a while. In fact, if you go back, I can pull up something I was looking at here. This is kind of a U.S. versus U.S. This is going back actually to 1992 is a chart that we have here. And it's really the ratio of international to U.S. performance. So it's the performance of international versus the U.S. So in the really from 92 up until roughly about 2000, or it says 94 here, I guess, but to 2001, you can see. I think this is actually from this point here. It's not to 92, so it's from this point up to really up until this point. The U.S. outperformed on a cumulative 180%, percentage point basis over a long period of time. And then you go through, another cycle where international outperforms. And now we've been through another cycle where U.S. equities have outperformed. So these things do tend to run in very long cycles in terms of U.S. versus non-U.S. So they're very hard to time. I think another thing to bear in mind. So, we could have said this in 2018. We could have said it in 2020, 2022. I mean, but at some point you do get to a place of where something is outperformed for so long that these kinds of cycles do turn. I think that one thing to bear in mind is that if you kind of strip away whether it's U.S. or non-U.S., because I think that has maybe a little bit less meaning in some ways than it did in the past, just at a high level, particularly when you talk about developed markets. One of the things that has really actually helped the U.S. is that when you look at, this is the MSCI USA, it's like the S&P 500, it's almost identical. The U.S. is much more heavily weighted in technology than really any of the other, particularly in the large cap side in particular, than really anywhere outside the U.S. And you just think about, Microsoft and Apple, and then even things that aren't really IT, but, the Amazons of the world and so forth. And when you get outside the U.S., and I'm just going to focus really on like Europe, for example, because that's kind of the closest comparison. And if you the EFA index or even the MSCI Europe index really is it's really like growth value. It's really like a value index. I mean, the only mega cap or large cap technology company there is going to be SAP in Germany. so it's really probably as much to do, probably a lot of it, can't really pinpoint exactly the figure, but a lot of it has to do with just simply a growth value divide as well. The outside the U.S. has typically been, much more of a bit of a, sort of a value, type of a play. So it may not just be the U.S. versus non-U.S. I think a couple things, just this is a quilt. So that we're not totally endpoint sensitive, right? So if you look at the trailing 5 or the trailing 10 years compounded, I put a circle. I was going to do the others. I didn't, but you can follow, like, here's, just year by year, developed markets, international, right? So it's not every single year, but you can just see U.S. has just been, pretty much a outperformer, almost across the board with a few exceptions. So that may be a comment as much about the U.S. doing well, in terms of the equity markets. But I would also, from a forward-looking, I guess 2 other things. One is that, it kind of shows you another way of looking at that cyclical environment that, in the lost decade, these things do shift. You had, where the S&P 500 declined, over the entire period, international slightly up, emerging markets actually did really well. We've been, the numbers aren't the same, but really in the opposite environment. Again, this is ending in 2019. But I think just I know we spent a lot of time talking about value as if it's just like this, just sort of like, dividing 2 numbers, but the growth is a component in value. And so just to give you a sense as to when we say that, and these are nominal figures, but when we make a comment about what we think the next 10 years is something that we think is going to be better for, let's say, outside the U.S. We're doing that on a variety of, we're looking at a number of things. One is so we look at the S&P 500 and say, well, what is the nominal forecast return for the S&P? And it's not meant to be a prediction as a precise figure, but it's a combination of a few things. It's a combination of, what dividend yields, are. So you can see, this is just sort of summing up, let's say, a 10-year forecast. So you can see dividend yields in the S&P somewhere around 2%. They can go up or down, but that's basically using where things are today. Looking, and this is on a bottoms-up basis, so we're taking basically bottom-up forecast earnings for all the companies in the S&P 500 over 10 years, and what is that figure, and then adding in either repricing due to PE expansion or contraction. Things have come down so much that actually, a couple months ago, this chart would have been actually a contraction. It would have been a minus, right? Because we would expect positive dividends and positive earnings growth, but it would have been so expensive that actually we would have had a negative. Now it's kind of gotten to be even, but you can see the long-term average for the S&P being closer to about 8.6%. So when we say lower than normal. The orange area, when you get into like Europe and UK, which is really the main components of we look at developed markets, you can see the dividends are a bit higher, so actually quite a bit higher. Earnings growth, which doesn't necessarily need to be higher. In fact, I don't even think it is in the UK numbers, but you can see this orange area in terms of repricing. So just again, relative to its historical valuations is actually a bit low. And so you can see when we think on a nominal basis, again, you have to. This doesn't mean our real return, because if inflation is higher, these numbers come down. When just to substantiate the view on a forward-looking basis, why we think it's undervalued. But again, just to sort of re-underline as a final point on that is that it's not just like a simple PE, because a simple PE, if you look at a simple PE, that doesn't account for I'd rather pay a higher PE for a higher growing company, as those of you who are in the investment field know, that could be cheaper, even though the PE makes it look more expensive. And so you have to think about what future earnings and is likely to be in combination with dividends. So I think the looking back, for sure, the looking forward, I think is much murkier and tilts things probably much more in favor of being outside the U.S. than inside the U.S. And I think the margin of safety in some ways really is kind of this orange area, because you're paying so much less for the earnings and the dividends by being outside the U.S. But you just don't know when. it's not a good timing mechanism. It could start this could start tomorrow, you know, or it could be a few years from now. But the correlations to this kind of data and 10 years looking backward are very, very high, and that's why we make those comments.
Okay.
Hey, Ross, a question on, let's see here, page 16. So the alternate investment. So Pointer is 7.5%, one of our higher allocations. And compared to everything else in that alternative investment, they seem to be struggling the most year to date.
Yeah.
Any idea as to why that would be, you know, them versus Ironwood, et cetera?
It's a combination of two things. One is it is because Pointer is a long short equity vehicle. Okay, so they long meaning, you know, the managers are long, you know, buying stocks that they think are, you know, are going to go up, and they are short meaning betting against stocks. In their case, betting against stocks that they think are going down, which is to contrast. Let's say there are other managers that are hedging their portfolio. Hedging meaning that they're taking very specific risks that they're concerned about, or that they want to sort of guard against, or they're hedging the market return against their longs. Whereas here they're looking for two things. They want to get the benefit of the companies they think are going to do well, and they also want to. They're looking for businesses that they think are basically going out of business, right? And okay, so
So Ross, give a
yep.
specific example. Do a technology example. So I'm long Microsoft, for example, and then I would be short. I don't know.
Well, I mean, there are to tell you how difficult shorting is. I'll give you a hypothetical example, but a plausible example would be Tesla. Okay, so the bear case on Tesla is, and again, I'm speaking. I'm not. I don't think there's any. I think probably it would take more. You have to be extremely brave to short Tesla, even if you thought that it is. If you agreed with this bear case, but the short case against Tesla would be, you know, you don't believe the numbers. You know, they fudge their accounting. They have typically when you look for you know, good shorts, you look for something where there's sort of a cultish atmosphere around it, a charismatic CEO, a promotional, okay, and at the end, and you know, Wall Street gets caught up in things, or you know, AMC, for example, or GameStop, one of these kind of, you know, I don't want to use any pejoratives, but you know, where people have kind of they've gone off over the ledge a little bit on some of these things, let's say. But fundamentally, you know, someone who knows what they're, let's say, doing, you look at it and you say, this company is an insolvent company. You know, barring, you know, some magic that comes along, right? So those are the types of names, you know, so those types of things would be short. Now, somebody would short Tesla because they think, or like Jim Chanos is very public about this. We don't have Jim Chanos here, so I can speak about it. But if you look up Jim Chanos, there are videos on him going back, you know, telling you that, you know, he believes that Tesla is an accounting fraud. He thinks it's a sham. He can get chapter and verse, et cetera, and is betting against it. Or those types of names. You know, there are certainly a lot of companies that go out of business and are, but the market just kind of keeps them up for some period of time. So that would be an example of, or those would be the, you know, the kind of things that they are looking for. You know, the technique of doing it is maybe something else, but they're looking for those kinds. What they're not looking for is, then the stock is 50. Everybody seems to be a little bit too in love with it. We think it's worth 30. Now they're looking for something that is X and is basically, you know, is zero, and the odds of it are you know, are high that they'll be zero. So anyway, that's as a general statement in terms of long short. in the long short world, and in particular where Pointer has concentrated, if we looked at Pointer, this time last year, we just go back and look at the July report or the June report, they would look head and shoulders above everybody else at that point in time. Just this time last year. So it'd be the exact opposite, Mark. I think what we would see in even 10 months ago, or even less than that. In a very, very short period of time, and that's when we talk about like market dynamics, one of the things that happens in market dynamics is that it happens to for whatever the reason. I mean, I have my in long short tends to be a bit more acute, and long short managers, they tend to have high quality businesses. Well, high quality businesses, a lot of them have been more and more growth businesses. They've been growth stocks. They've been Netflix has been up in there, right? That's been a name that's been in certainly come down a lot, and that's a name that a lot of these types of managers would have owned, along with some others, but more sort of technology-oriented type businesses. And the world changed obviously very quickly, overnight. A lot of those names have come down a lot. But I would just make it my observation on these things, Mark, is that not just in this environment, but we have noticed in that long short managers do not seem to handle market transitions very well. And so it doesn't knock me out of my chair that they've not done well in this period, because this isn't just the market going up and then the market going down, which they can actually do pretty well. They kind of, move their exposures around. This is a major, macro shift in markets. The underlying assumptions that you would even contemplate, I think, in terms of the why did growth stocks do as well as they have? Well, to make up a sort of a simplified example, interest rates, being as low as they are, made a lot of these companies, worth a lot more, right? Just like bonds, right? A long duration bond, interest rates are low, so the bond is worth more. Interest rates have come up, so suddenly these businesses that look sort of, inexpensive, even though they're still growing. By the way, the earnings on a lot of these companies that I, Tesla aside, but like, I'm using Netflix as sort of like a, sort of a middle ground. The businesses themselves, while some things have have become a bit challenged, they're not going from growing businesses to shrinking businesses. They may be growing at a slower rate than the sort of pull forward effect during COVID, but the valuations have come down tremendously because interest rates have shot up. But Amanda, who was helping me in the background here, shared with me that so this time last year on the page, and Amanda, I don't have the year-to-date column, but let's say the 1 year column, right? Is that the 1496? Amanda?
Hold on.
I think that's right.
That's the 1 year.
Yeah. So if you looked at, this time, it's actually there's some symmetry to that. The 1 year column in this time last year was up. I'll just round it. Was up 15. The 3 year column, instead of being up 2.4, was up 10 per year. 5 year column, instead of being up 435, was up 10 per year. Since inception, was up a little. Was up about 10 1/4 per year. All of that doesn't mean anything in the sense that we're looking at it where things are today. It's not meant, but it does. It is just very interesting that or I guess it makes sense in relation to what we've seen occur kind of in where what their underlying investments are and what their strategy is. I would not have been able to give you a figure. I wouldn't have been if you told me the market would be down, X percent. I would expect them to go down. Typically, not always, but typically not as much. They've gone down more, but I think that a lot of that has to do with kind of the orientation of managers to own more growth names. And I also think, Mark, I guess there's also when you think about growth and value, which I think are probably really not terms that a little bit misleading sometimes, but but at least you know in your mind like what things are in a growth index and what things are in a value index. A lot of managers that look for, you hear the term quality. They do not invest. They will not invest in commodity businesses and commodities. Energy inherently is a commodity business, and it's in the commodity business, right? So the fact that energy prices, various commodities have done well. Some of those stocks have responded in kind. They're not going to own those businesses because in their minds, those are just blips. Those are not businesses that, that they can look forward in the next 10 years and say, these are high quality businesses. They're just price takers, price consumers. So it's not stocks that they want to own. So the fact that it's not just what they do own, it's what they don't own that some of the other investments that we have, will actually respond well to, that they will get a bit of a benefit when commodities, let's say, jump up, which is really the only thing that has really moved up at all this year, just in terms of major asset classes.
Thank you,
We spent a
sir.
lot of time. Yeah, we'll see them. I think we'll see them next week, but we spent a lot of time, as you would imagine, with them, and are doing so now.
Anyone else?
Nope.
Are there any of the funds right now that, I don't know, you have mild concerns over? Any manager turnovers, any style drifts, for lack of a better term? Any of the alternative or the traditional side?
No, I'm actually very, things will come up when they do, but everyone is actually I think in very, very good shape certainly from a due diligence perspective.
I know I in particular complained to you about Abbey Capital for a long time because it just, as the markets kept going up, it didn't seem to be, and now here it is, year to date up 23%. So, diversification does matter.
Yeah. Well, I think it's up closer to about 28 as we sit here today. So it's it's just very interesting and a very difficult environment. And I will say this, that if you want to kind of go back and study these things, the world that they live in, managed futures, or even Graham Global Macro, these strategies, these style of strategies, and in fact, many of even the people who are still around, you look back in the 70s, let's say, really when these things got going, and we actually go back to even the early 80s, that is really the first area of alternatives that in any of our portfolios, and in some of them, they do go back that far, is in the macro space. And, during that period of time, and as everybody's sort of looking back in the history books, stocks did poorly, as we know, and bonds did poorly. The Paul Tudor Jones of the world, those types of names, even the Grahams, that lineage, it was the macro managers that actually performed well. So if you relive, it never comes back the same way, but if you relive a 70s type environment, a stagflationary environment, it may be that stocks and bonds do poorly, and every asset class does poorly, with the exception of the managed futures, like an Abbey and the more sort of fundamentally oriented macro managers like the Grahams of the world, because that was the heyday for those strategies, which is kind of interesting. But they have been left for I would almost say left for dead. Nobody wanted to invest in these things for past 10 years. Nobody wanted them.
Okay, anyone else? I think if that completes that portion, the only thing we have left on our agenda this evening is just information in the packet or on the email, whichever you're using. There's just a summary of pension disbursements, and a summary of bills. Jim, just to clarify something I had asked you about earlier, I did go back to I reread the minutes, and I think we do have a full actuarial evaluation.
Mike, I was just gonna chime in on that. Yes, I stand corrected. I get confused with OPEB,
No, that's okay.
which we're on a
Okay.
different cycle on, and that's been my world the last couple of weeks.
If
But
we-
yeah, you're absolutely right. June 30 or July 1st, 2022 is a full valuation.
Yeah,
So
so
that
even
will
though,
take into
the-
consideration our census experience, versus, what was projected. We have had a lot of turnover in the last couple of years. In a lot of pensioners in town hall, either leaving work, or retiring. So, that could have a difference from that perspective.
and any
yeah.
investment performance gets smoothed out anyways, so we don't get hurt
Absolutely.
by-
So there's
particularly
a
bad
5-year smoothing. But yeah, this is the full valuation coming up. They're in the process of working on that now.
Okay. Our next scheduled meeting, the November meeting is usually the day after the election, except for about every 5 or 6 years, and it's not this time. So it is on Wednesday, November 2nd. I believe if I have my calendar right, because the election is
That's right.
the first Tuesday after the first Monday. So election is as late as it can be this year, November 8th. So we will meet on Wednesday, November 2nd, and perhaps we will meet, live at Town Hall, perhaps.
That'd be nice.
So,
Hey, Mike, I just want to bring up, not that's going to matter, but just I will be on vacation that week,
okay,
so I will not be available.
okay,
Definitely. If we
then,
move- if there's something happens, then
okay,
whatever.
you know what, so that's your plan right now, that's fine. So maybe, because it's, maybe, Jim, we should just consider, knowing that so far in advance, perhaps we can make the meeting, if that works for people, Wednesday, the 9th. Once we know in advance, because you guys are very accommodative with me, and I appreciate it, Beck.
So is there anyone besides Mark that at this point knows whether November 2nd is difficult?
it's a definite out. We're on, be on vacation, the last week of vacation. So I'll be back that Friday or Saturday. but I
Yeah.
won't be Available.
Is there anybody else? I know it's tough. Because
Just logistically, okay.
if we move it, it always seems that we have at least, one person that's
Okay,
gonna have a
that's fine.
problem.
I just didn't know if it was easy to try to figure
I
it
could
out.
certainly send out an email to see if anybody has, any conflicts with the 9th at this point.
Okay.
It comes down to if we need a vote on something, I can tap in and out.
No,
At least
that's
we can get
fine.
the full
I
meeting,
just,
right?
we meet so few times, and if we know enough in advance, and I appreciate you telling us that now, because, once we get into basketball season too, we're actually playing on election night. So that's our opening night, November 8th. So I know the 9th won't be a conflict. So, but it's nice to have everyone there if we can. You going anywhere fun, Mark?
Sanibel Island,
Ah, very nice. Anything with the word island in it is a great
Yeah.
place to go.
right?
So, all right. So not to try to screw you up, Jim, but if it's possible for us to do that, that would be great.
Yeah, I'll send out an email, and I'll certainly look into about getting a live meeting going. I know we've had issues with conflicts with recording the meetings when we meet in council chambers. But hopefully we can get that all worked out.
We're 3 months out, so we would be 14 weeks from tonight if we move it to the 9th. So, oh no, I'm sorry, I'm bad. No, we're about 10 weeks because we're out a few weeks already. So, all right.
And if the 9th, if
So the 9th is
other
the 9th.
members have a problem with that, then maybe we'll leave it. We'll see what happens.
Okay. yeah, we can at least put a feeler out early enough. Because we're already in September this week. Okay, anyone else have anything for the good of the order?
No,
Okay, well, Ross and Amanda, thank you. And thank you to all for joining, and we will see you tentatively on the 9th, if that works for Jim and everybody.
good.
Okay, thank you all. Good night.
Enjoy
Very
the
good.
summer.
Little sunshine still out there.
You want to adjourn the meeting?
Yes. Oh, yes, I'm sorry. I make a motion. Sorry. I will make a motion to adjourn this meeting. Do I have a second?
Second.
All in favor?
Aye.
The details. Thank you, Jim, for reminding me of that.
Yep,
Okay, thank you all.
thank you.
Thank you.
Good night, everyone.
Now.
Thank
Good
you.
night.